Hello and welcome to our Financial Literacy Education series, where we help you get a better understanding about your money, become more engaged with your money, and hopefully make better decisions about your money. My name is Corin Jacker. I'm from Priority One Wealth Management Group. Throughout our series, we've been covering a range of topics, including why we need to get to know our money, getting good advice, looking at our cash flow and establishing surplus cash, which is an important foundation for wealth creation. We looked at all the wealth creation strategies: investing money in your own name, debt reduction, superannuation, gearing. We looked at the decisions around managing your assets and asset class analysis. Looked at retirement issues, aged care considerations, insurance and protecting your assets, and estate planning. Today though, we're going to do something a bit different. We're going to look at behavioural finance. And this is just going through a number of different biases that we have, not only in relation to money, but in relation to just about every decision we make in life. And having an understanding of those biases and having the ability to recognise them and then create a more rational response to the way we're thinking. So, what is behavioural finance? So behavioural finance combines a theory of psychology with economics. And it helps explain why we often make irrational decisions around money. Much of these biases, though, that we have, not only about money, but in most areas of life, are built into our DNA. They're part of the flight or fight response. They allow us to make decisions based on previous history, previous analysis, previous thoughts. First one we want to look at is cognitive dissonance. So this is basically where two things, two thoughts, two pieces of information are conflicting with one another and can make us feel uncomfortable. Often to counter that, we'll then obscure the information that doesn't fit right with our thoughts in order to justify the thought or action we're taking. From an investment perspective, it can mean that we're overly focused on a particular stock or exchange traded funds upside whilst ignoring the risk. So we might get information about the risk, but because we've made this decision that we're comfortable with of buying this investment, those conflicting information about the risks are making us feel uncomfortable, and we'll find ways to discount that information. Conservatism. So this is where prior views form our decisions without taking on or acknowledging new information. So for recent stock, his performance is poor and it's at odds with the previous positive outlook or economic position. The tendency is to disregard that latest set of information. So we need to make sure we don't get stuck in prior beliefs. When new information comes, we need to be prepared to change our mind and change our views in relation to investments. Confirmation bias. This is quite common in most of the areas of our lives, where we have a tendency, once we've made a decision, that we find information that reinforces that belief and we exclude information that doesn't. So the lesson is to try and evaluate information from a neutral perspective. So have a look at it and be aware, are you making a biased decision because of your previous held beliefs that you want to have confirmed, or should you be open to this new information changing your views? Loss aversion. So this is quite common in that psychologically we feel the loss that we make in relation to our money much more than we feel the equivalent financial gain that we may make. So if we lose $100, the pain of that is much more than if we gain $100. Sometimes when we lose that money we then start making irrational decisions about what we do with that investment. So we need to be prepared to ignore what we've gained or what we've lost in relation to an investment and view it from today and its future prospects in whether it's a good idea or not what's happened in the past. Overconfidence, again, this is quite common. So this is where we've got an overinflated belief in our own ability to do things. Research shows that driving on the roads, a large percentage of us feel that we're above average drivers. Same for fund managers. So in a recent survey of 300 fund managers, 74% responded they're above average, 6% average. So literally no one thought they were below average, which is a statistical impossibility. Portfolio turnover and return. So what we're saying here is that the research indicates the more we turn over a portfolio, often that leads to inferior results. And often we're turning over that portfolio, again, based on biases that we have. And one of them could be particularly overconfidence. So we want to, again, assess what we're doing. Are we making rational choices about our trading? Avoid trading too much and make an honest assessment. Anchoring is where we use one piece of information to view another piece of information. So in this example, we're saying if the first piece of information we get that a t-shirt costs $1,200, then we see a second t-shirt that costs $100, we might view that as cheap compared to the first one. So we've anchored our view in that first piece of information. In isolation though, we might see a $100 t-shirt as being expensive. So again, just be prepared to understand, are you anchoring your view based on another piece of information which should or shouldn't necessarily impact the view you're taking on the current piece of information. So familiarity, that's where we often shop at the same places, buy the same clothes. And in investment, we often invest in the same things that we're familiar with: cash, term deposits, Australian shares, property. So we've got to be careful that we're not removing ourselves from potentially things that we may not be familiar with, but might be good investment choices. Another one is self-attribution bias. That's where we're simply saying all the good results of my effort, anything that happens that's not good is due to bad luck or someone else's problem. Some other biases, availability, so that's where we're influenced much more by recent information. So if there was a recent financial crisis, we're much more to view investments in relation to that short-term impact. Representativeness, that's basically where we look at stereotypes and we imply information based on those stereotypes. So if there's a high-profile company, we often think that that must be a good investment, which is not necessarily the case. So as a checklist, and this is the same for every decision we make, not just investment decisions, am I being anchored by irrelevant factors and by the way I frame something? Am I responding to a memory or a judgment based on similarity? Am I being too conservative in updating my views based on new information? So what can we do about it? So basically having an understanding and awareness of these biases is a good start. So next time you're making a decision about money or about anything else, have a think about why you're coming to that decision. What information are you basing it on? And is it information that's based on a bias that may not be correct or relevant for the decision you should be making? So as I said, using these biases and the information about them doesn't necessarily make it easy to make investment decisions or any other choices, but just having that awareness helps us go through and hopefully come up with more rational decisions, which is what we want in relation to managing our money. We want to make a rational decision based on the appropriate information we have and having an honest assessment of that information in a neutral way rather than in a framed way based on our biases. Thank you and goodbye.